Welcome to another episode of A Quest for Twice. Today is November 6th. Several companies that in my portfolio reported the earnings, so today I'm going to review some of them. The first one is Energy Transfer. So Energy Transfer, in terms of financial metrics, reported a fairly boring earning I'm going to review. The most important update is on the M&A front. As a reminder, Energy Transfer bought Woodford Express for $500 million last year and the Lotus for $1.5 billion earlier this year. And in the most recent quarter, Energy Transfer is acquiring Crestwood company for $7.5 billion. So that's a relatively major purchase. As a result of the acquisitions, its 2023 estimated EBITDA was raised. Now the EBITDA is estimated to be $13.5 billion, more than $300 million more than previous guidance. No change to its net debt. So at the current price of $13.5, its EV over EBITDA is about 6.5. Based on my estimate, its 2023 DCF will come in around $7.7 billion. So that gives us a price over DCF about 5.5. I consider that as a good value. Its capex guidance is about $2 billion or slightly less, and the forward dividend is about 9.3% yield. So if we add the capex and the dividend together, that's about $6 billion. That leaves about $1.7 billion of free cash flow after paying capex and dividend. So the company still has a lot of firepower, can be used to pay down debt as well as buy back shares. It'll be interesting to see how that develops. Equitrans also provided the updates. On the major project side, its Ohio Valley expansion project is targeted to finish in the first half of next year. Its water project is coming along nicely. The third quarter EBITDA was $12 million compared to $7.5 1 year ago. It suffered a setback related to the Mountain Valley pipeline. Now the start date is delayed to first quarter next year instead of fourth quarter this year. And the cost also increased to $7.2 billion instead of $6.6 billion. The management attributed that to higher construction standard as well as the initial difficulty to ramp up a construction crew. However, in its recent earnings call, the management expressed great confidence in finish the final stretch of the MVP pipeline. So let's look at the cash flow situation. So the running EBITDA next year will be about $1.34 billion plus additional from Ohio Valley Connector expansion project. The deferred revenue next year looks like will be about $145 million compared to $330 million this year due to production decline. So this year I consider the gathering the pipeline capex of $250 million as a maintenance capital. So assumed the ongoing maintenance capital will be $300 million. No change to interest payment of $440 million. So next year's DCF will be about $750 million to $950 million, depending on how much is spent on gathering capex. The dividend payment is 320 million and growth capex about 280 million. As together, that's 600 million. So we'll still have significant money left to pay down debt. The management indicated that the target is to reduce the debt to EBITDA ratio to about 4. Note that the price over DCF is 5.2 or even less, depending on the amount of DCF. So I consider that as a pretty good value. Now let's look at JFROG. So JFROG continued its steady growth. Compared to 1 year ago, its third quarter revenue grew 23%. That's a slight deceleration from 24 and 25% in the first half of this year. However, the industry deceleration was seen as bottomed out. And its trailing 12-month net dollar retention rate, 119%, comes in very close to 120% guided for the end of this year. So considering the technology industry has been cutting back and reducing cost, its revenue growth rate is fairly decent. So can the fast growth continue? That depends on mostly its Enterprise Plus revenue. So in the third quarter, that was 46% of the total revenue for the amount of $40.8 million. That compares to $28 million 1 year ago. It's a very fast growth. The other revenue grew to about $48 million from $44 million 1 year ago. It's a little less than 10%. However, considering the customers likely will grow and add more service and graduate from non-Enterprise Plus package to Enterprise Plus package. So the 10% growth is still fairly decent. Shows that the customers are using its products more and more, and with more and more new customers using JFROG products. So I think there is still a long runway for JFROG to increase its revenue and achieve a higher profitability. Next, let's look at INMD. Its earning update was a disappointment. In the third quarter, its revenue was $123 million, grew only 2% from 1 year ago, compared to 40% revenue CAGR before 2023. The management blamed on the seasonality and higher interest rates on the very lukewarm growth. However, the management also lowered the full year revenue guidance to $505 million instead of $535 million as in the previous guidance. So my takeaway is that INMD growth now is more dependent on the macroeconomic condition instead of in the past with a very good product and a low market penetration. It just grow regardless of the macroeconomic condition. Therefore, I suspect the runway ahead is limited. The good news is that its gross margin was steady at 84%, so there was no sign of cutting price in order to sell more units. So let's look at its valuations and risks. So with its price at $21 per share, its PE is 8.9, and EV over EBIT is only 5.6. That's because of its market cap was about 1.8 billion, but with $676 million of cash and equivalent on hand. So its EV is a third less than its market cap due to its net positive cash position. So that appears to be a very deep value. I think part of the explanation was because of the ongoing war between Israel and Hamas and the fear of that impact on EMOD because EMOD has its production in Israel. Looking at the valuation level, the PE and the EV over EBIT basically tells us the market doesn't believe EMOD will grow in the future. As a matter of fact, it may even shrink in terms of revenue and profitability. I don't see any sign of that. So I do believe EMOD has a lot of value. However, I do want to point out there is a threat to the investment thesis, which is the management refused to buy back shares despite the large amount of cash on hand. Then the question is what management plans to do with the large amount of cash. If they buy another company with a very high premium, then that will be a waste of capital. Then the value would not be as attractive as the initial appearance. So there is some uncertainty there. In my opinion, the best use of the excessive cash is to buy back shares or even distribute as a dividend to shareholders. So only time will tell how this gets resolved. Now let's look at the Mercado Libre. Mercado Libre reported a very strong quarter, and in a way it is boring because its strong growth has been really consistent. Let's look at the users of Mercado Libre's platform. On the commerce side, those are shown as a gray bar on the right. The numbers keep increasing. Even the first quarter this year had a higher number of buyers than the fourth quarter last year, despite that last year benefited from the Christmas and other holiday seasonal shoppings. And when we look at the unique fintech users, growth even more steady, just shows the very strong position of Mercado Libre in the several markets it operates. As a result, the network effect will become stronger and stronger. Its moat against other competitions will become wider and wider. Now let's take a closer look at its various segments. Bars are the common segments. The gray ones are the third-party sales, and the orange ones are the first-party sales. So we can see steady growth from 2.5 years ago. As I mentioned, it gets a little boring because the growth has been so consistent. Now let's look at its fintech segment. Those are the two lines in the figure on the right. The bottom one is the credit revenues. You can see it had a stagnant phase from second quarter last year to the first quarter of this year. Then it started to grow in the second quarter and the third quarter this year. Fintech services, that's the thick green line. It just grew consistently if we just look at the wedge between the credit revenues and the fintech services revenues. Another remarkable point to make is the gross margin in the latest quarter grew again. That's due to economy of scale and better first-party margin. So the gross margin in the latest quarter has been the highest in the last 2.5 years. Now let's take a closer look at its fintech segment. The third quarter revenue was 1.6 billion. On the digital payment side, the Total payment volume in last quarter was $47.3 billion, and the digital account TPV was 7.6 billion comparing to 10.6 billion 1 year ago. That's almost a 70% of increase. On its commerce side, the TPV was about 30 billion comparing to 21.6 billion. That's over 40%, and still a very enviable growth rate. The growth is even more remarkable if we compare to the third quarter 2020, so that's 3 years ago. The digital account TPV was 3.3. That's about 20% of the current quarter TPV. And the commerce TPV was 11.3 billion in the Q3 2020. That's about a third of its current commerce TPV. So its fintech business growth has been breathtaking. Its revenue on the credit side can be described as explosive. Now it's about 41% of its fintech revenue total amount. If we look at the credit portfolio in the last 2.5 years, it was barely $1 billion of portfolio in the third quarter 2021. That was 2 years ago. But now it's approaching $3.5 billion of portfolio in the most recent quarter, 3.5 times larger. What about its profitability? So that's measured as a net interest margin after losses for its credit portfolio. In the most recent quarter, it was 37.4%. That's fairly decent, approaching the high achieved in the Q4 last year of 39%. That's impressive because last year the credit portfolio growth was held back to improve profitability, and in this year the credit portfolio has been growing and still achieved a very high profit margin. Now let's take a look at my investment thesis. So I believe it's a fast growth company with a wide moat and a fair valuation. At $1,370 per share, its price over sales is about 5.3 versus 14 for Amazon before pandemic. It's a wide moat from a network effect and a high switching cost. That's reflected in its high and growing take rate. On the commerce side, its Q3 take rate was 18.7% compared to 17% 1 year ago. That's driven by leveraging its logistic network as well as better contribution from advertisement. On the fintech side, its take rate was 3.45% in Q3 this year compared to 3.81% from last year. That's mostly driven by the impact of credit revenue. As we can see, the credit revenue has a lower take rate compared to the other fintech services. So because MELI has resumed very fast growth in its credit portfolio, so the revenue mix has changed. As a result, its take rate has suffered a little, which is okay because there is so much growth ahead for its fintech segment. So the overall investment thesis stays the same. It's a very fast growth company with a wide moat and a fair valuation. It's really a wonderful business to buy at a fair price. I would think that's a very good deal. This concludes this latest episode of Quest for Twice. Until next time, happy investing.